The three financial statements. Financial statements are crucial for assessing the financial health of a business. They provide a structured and detailed overview of a company's financial performance and position. There are three main types of financial statements: the income statement, the balance sheet, and the cash flow statement. Introduction to financial statements. Financial statements are formal records of the financial activities and position of a business. They provide detailed information about a company's financial performance, cash flow, and financial position. The three primary financial statements are: 1. Income statement. 2. Balance sheet. 3. Cash flow statement. Each statement serves a unique purpose and provides different insights into the business's financial status. The income statement. The income statement, also known as the profit and loss statement, shows a company's revenues and expenses over a specific period. It provides insights into the company's profitability. Some of the key components of the income statement are: 1. Revenue. This is the total amount of money earned from sales of goods or services. 2. Cost of goods sold, COGS. These are the direct costs incurred to produce the goods or services sold by a company. 3. Gross profit is revenue minus cost of goods sold. It shows the profit a company makes after deducting the costs associated with making and selling its products. 4. Operating expenses are the costs required to run the company that are not directly tied to the production of goods or services, for example, salaries, rent, utilities. 5. Operating income is gross profit minus operating expenses. It reflects the company's earnings from regular operations. 6. Other income and expenses includes non-operating items such as interest income, interest expenses, and taxes. 7. Net income is the profit or loss after all revenues and expenses, including taxes, have been accounted for. The balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It shows what the company owns, assets, what it owes, liabilities, and the value of shareholders' equity. The key components of the balance sheet are: 1. Assets. These are resources owned by the company. They are divided into current assets, items that can be converted to cash within 1 year, like cash, accounts receivable, inventory, and non-current assets, like property, equipment, and long-term investments. 2. Liabilities. These are obligations the company owes to others. They are divided into current liabilities due within 1 year, like accounts payable, short-term debt, and long-term liabilities, like long-term debt and deferred tax liabilities. 3. Equity. This is the residual interest in the assets of the company after deducting liabilities. It includes common stock and additional paid-in capital, which is money invested by shareholders, and retained earnings, which is accumulated profits not distributed as dividends. Valuation methods for balance sheet items. Balance sheet items may be valued in different ways. They include: 1. Historical cost. This is the original price the item was purchased for. 2. Fair market value. This is the current market price of the item. 3. Book value. This is the historical cost minus depreciation. The cash flow statement. The cash flow statement shows the inflows and outflows of cash over a specific period. It helps assess the company's ability to generate cash to fund operations, pay debts, and invest in future growth. The key components of the cash flow statement are: 1. Operating activities. These are cash flows from the primary revenue-generating activities of the company. They include cash receipts from sales and cash payments to suppliers and employees. 2. Investing activities. These are cash flows from the purchase and sale of long-term assets and investments. They include capital expenditures and sales of equipment or investments. 3. Financing activities. This cash flows from transactions with the company's owners and creditors. They include issuing or repurchasing stock, borrowing or repaying loans, and paying dividends. Let's now look at some financial statement examples. First, we'll start with the income statement. And here we see the income statement starts with revenue of $500,000, cost of goods sold, $300,000. That leaves us with a gross profit of $200,000. That is 500,000 revenue minus cost of goods sold of 300,000. Next, your operating expenses such as salaries, 50,000, rent 50,000. And that leaves us with operating expense of 100,000. Operating income, which is the gross profit of 200,000 less operating expense of 100,000 is 100,000. Then we have some non-operating expenses. This includes things like interest expenses, and this is 10,000, which is a negative here, and that leaves us with net income of 90,000. That is 100,000 in operating income less 10,000 in non-operating expense. That is an example of an income statement. Simplified here, but in practice, it might look way more complex than this, but that's how an income statement would look like in the real world. Next, let's take a look at the balance sheet. The balance sheet will start with assets at the top. And here we have assets such as cash, 50,000, accounts receivable, 75,000, inventories, 100,000. And these are what we call current assets. And current assets are those which can be turned into cash in less than 1 year. And the total for our non-current assets is 225,000. We next have long-term or non-current assets, such as property and equipment, which is 200,000. Long-term investments, 75,000, and this gives us total non-current assets of 275,000. Our current assets plus our non-current assets gives us total assets of 500,000. Next, we have our liabilities and equity section. Our liabilities start with current liabilities such as accounts payable, here it's 50,000. Short-term debt, 25,000. This gives us total current liabilities of 75,000. Next, we have long-term liabilities, such as long-term debt, 150,000, deferred tax liabilities of 25,000, and that gives us total long-term liabilities of 175,000. And similar to current assets, current liabilities are those that are due in less than a year, and long-term liabilities are due more than 1 year. Next, we have equity. And equity is composed of things like common stock. That's the amount that shareholders have invested in the company. And here it's 100,000. Next we have retained earnings. These are the profits which have accumulated in the company over the years, and have not been paid out to our shareholders. And here that is 150,000. Adding these two gives us total equity of $250,000. Adding up the current liabilities of 75,000 plus non-current liabilities of 175,000 plus equity of 250,000 give us total liabilities and equity of 500,000. And what do we notice here? Our liabilities and equity are equal to our assets. And this again is the accounting equation, which is asset equal liabilities plus equity. These two must always be the same, so your balance sheet will balance. If the balance sheet is not balanced, then something is definitely wrong with your accounting. Next, we look at a cash flow statement. The cash flow statement has 3 sections: operating activities, financing activities, and investing activities. We start with operating activities, and this is cash generated from the company's normal operations. Here we see cash receipts from sales, 400,000. That's a cash inflow. Cash payments to suppliers, which is an outflow, is 200,000, and payment for operating expenses, again, that's gonna be an outflow because it's an expense, and that's 100,000. And all 3 of them, summed together, give us net cash from operating activities of 100,000. Sometimes this could be an outflow, but in this case, it's actually an inflow. So we have 100,000 in net cash from operating activities. Investing activities, we have purchase of equipment. This is when investment is made into or out of the business. Purchase of equipment, that's an investment, but you have to pay for the equipment. So it's a cash outflow of $50,000. Sale of investments, the company might have some funds that are invested in securities and it decides to sell some of those so it gets cash, and that's an inflow. Netting these two gives us net cash from investing activities, which in this case is an outflow of $20,000. Next is financing activities. Financing activities include things like selling common stock to shareholders, and that's an inflow. Here, it's $50,000. Repaying long-term debt or other type of debt, that's a cash outflow. And in this case, it's $30,000. These two net together give us net cash flow from financing activities of $20,000. And in this case, it's an inflow similar to the net cash from operating activities. So we had inflows from operating activities and from financing activities, and we had an outflow of $20,000 from investing activities. That leaves us with a net increase in cash of $100,000. Over the course of whatever period this cash flow statement represents, this company would have taken in a net cash of $100,000. We then add cash at the beginning of the period, which in this case, it was $50,000. At the start of the financial statement period, the company had $50,000 cash in its bank account, and then we added to the increase in cash, and this gives us cash at the end of the period of $150,000. This $150,000 should be in the completed balance sheet at the end of the accounting period. Those are examples of financial statements in practice. Notes to the financial statements accompanying every set of financial statements are notes, which provide important additional information. This includes 1. Accounting policies used. 2. Breakdown of complex line items. 3. Disclosure of risks and uncertainties. 4. Details on debt covenants, lawsuits, and other potential issues. Reading and understanding these notes are essential for a complete picture of a company's financial situation. Analyzing financial statements. Understanding how to analyze financial statements is crucial for gaining insights into a company's financial health. Here are some key metrics and ratios to consider. 1. Profitability ratios. Measures how effectively a company generates profit. Examples include gross profit margin, operating margin, and net profit margin. 2. Liquidity ratios. Assesses a company's ability to meet short-term obligations. Examples include the current ratio, current assets, current liabilities, and the quick ratio, also called the acid test ratio, which is cash and equivalents plus marketable securities plus accounts receivable, current liabilities. 3. Solvency ratios. Evaluates a company's long-term financial stability. Examples include debt-to-equity ratio, which is total liabilities, shareholders' equity, and the interest coverage ratio, which is calculated as earnings before interest and taxes. EBIT, interest expense. 4. Efficiency ratios. Indicates how well a company uses its assets. Examples include inventory turnover and accounts receivable turnover. Conclusion. Understanding the three statements and how they interrelate is crucial for assessing a company's financial position, profitability, and cash management. Each statement provides unique insights. The income statement shows profitability and operational efficiency. The balance sheet provides a snapshot of the business financial position and solvency. The cash flow statement highlights cash management and liquidity. By analyzing these statements, business owners, investors, and stakeholders can make informed decisions to guide the company's financial strategy and growth. This brings us to the end of the video. I hope you learned a lot from this video. Please remember to like, share, and subscribe. I will see you in the next video.